Welcome to our webinar this morning. Thanks very much for joining us. I'm delighted to be joined today by Ben Chernoff, Director here at Davis Grant, who's going to take us through our presentation, which is all about tax and what to expect in 2022. Now, obviously, things may change next week with the Chancellor's spring statement, but this is what we know so far, and it's a good opportunity pre-5th of April to start getting affairs in order and making the most of the tax release that you have before the 5th of April. We're scheduled to run for roughly half an hour, 45 minutes today, depending on the number of questions that we get. Just a couple of housekeeping issues. Hopefully you can all hear me, but if you're struggling for any reason, if you select your audio settings and just test your speakers, give us a shout on the chat if you're having any problems. We will hopefully have time for questions at the end of the presentation today, which Ben's happy to take. So submit those via the Q&A button on your Zoom toolbar. We'll be able to see those questions coming in, and as I say, we'll try and answer as many of those live as we can before the end of the presentation. And if you do need to leave and want to rejoin, just click Leave Meeting and rejoin using the link that you've used to come in this morning. Okay, so I'm now going to hand over to Ben. We are recording this webinar, so if there's anything that you want to recap on, we will make an on-demand version available on the website later on today. At this point, I'll hand over to you, Ben. Away you go.
Perfect. Thanks, Jo. Good morning, everyone. Hope you and all your families are well. So as Jo mentioned, we're going to really look at a few different taxes today, looking at corporation tax for companies, income tax for individuals, inheritance tax, capital taxes, and then really looking ahead to the future of tax and making tax digital, which I'm sure a lot of people are aware of now, but it's going to be affecting a lot more people over the next 4 or 5 years. So we're going to kind of dig into these various taxes, how you can potentially use your allowances up before the 5th of April, and also looking at the changes in the tax system that are coming ahead of us. So as you probably do know, the tax year is finishing on the 5th of April, and really to maximise your tax release and allowances, it's vitally important that you kind of take that review and make sure that you are making the various payments or using the allowances before the 5th of April, because for a lot of these allowances, if you miss the end of the tax year, you can't then go back and use them. So we're middle of March now. We've only got, say, 3 weeks till the end of the tax year. It's really important that if you see anything that we discussed today, that you speak to your advisor, you speak to your financial advisor, and you make the various payment costs up. When business tax, be aware of, for anyone that has a company and receives dividends, every shareholder or every individual gets a £2,000 zero rated dividend band. So up to the 5th of April, if you've got a company that's got the reserves and has got the profits to make that dividend, it is very useful to, even if you don't need to take the money out of the company, to just declare that dividend for £2,000, because you're never going to get that band back. Everyone gets it at the moment. If you're a shareholder, you get it each tax year. And again, you don't pay any tax on that 2,000. And the rise in the national insurance, they've also, from April this year, they've also increased dividend rates by 1.25%. So if you can get an additional dividend in before the end of this tax year, you will be saving that 1.25%. Again, yes, you may save some small amount of tax, but by declaring it before the 52-23, your 21-22 tax return, and therefore the tax will be due earlier. So it's weighing up, is it better to pay the tax earlier but save a small amount of tax? Also, I'm sure if you run a company, you're aware of the increase in corporation tax, and that's for here starting from April 23, and the rates increasing from 19% to 250,000, and there'll be a marginal increase from profits increase up to the 250,000. So it's quite a big jump for a lot of companies. The other types of things that business owners should be looking at is capital allowances. So years and on the annual debt, COVID, the revenue, the super deduction, which means if you spend £1,000, you actually submit roughly to 25 R&D claims a year, and really important for kind of service or even just a process that has not been done before and is new and innovative. And therefore, if you think you have done this, please do speak to your advisor or speak to us, because there's potential for you to, one, reduce your tax bill, or two, to potentially actually get cash back from the revenue. Capital gains tax, again, in terms of business tax and owning assets in businesses, each year at the moment you get £12,300 capital gains tax allowance, and all these allowances have been frozen for 5 years from 2021. So again, if you own a share portfolio that has made some gains, a tax efficient way of disposing of those gains is spreading it over a few years. So if you've made, say, £30,000 of gains, why not sell up to 12,300 of those gains before the 5th of April, and therefore you won't pay any capital gains tax on that, and you can then spread it over the next few years to keep your capital gains tax to nil. And then also business asset disposal relief, which used to be called entrepreneurs relief, and this is for when you dispose. There's certain conditions you have to meet, but if you do meet those conditions and you sell a business, you can effectively pay 10% on 10% tax, entrepreneurs relief, instead of the current high rate tax of 20% capital gains tax. And just to point, that was reduced last year from 10 million up to £1 million limit. So just to finish off with business taxes, just some other things to think about and some tips. Looking at salaries and kind of a tax efficient level of having your salary compared to dividends. Normally for a shareholder director of a business, you would look to perhaps put them on up to the national insurance threshold, which is about 9,600 a month, and that will mean you get tax relief on that salary and you don't pay any national insurance or PAYE. There's a wider range of benefits that you could potentially get. Obviously, with all benefits, there's P11D issues and you do pay tax on them, but there are some that are very tax efficient, such as electric cars. And a lot of business owners now are looking to get an electric car, because where on a petrol or a diesel car, you may be paying anything from 20 to 35% as a benefit in kind. On an electric car, it was 1% and it's now going up to 2%, but still that is a very low rate to pay a benefit in kind on. And also, if you're an employee and you want to get an electric car and your employer agrees that you can get one, you can do that as a salary sacrifice scheme, which means effectively it comes off of your gross salary, and therefore you're saving the tax, and your employer is saving the national insurance. Just to touch on a few other things, EMI schemes, again, these are just a tax efficient method to give your employees ownership and shares and ways to keep them happy and retain them. Expenses, are you making sure you're claiming all of the allowable expenses that you can? And then, like I mentioned before, with salary and dividends, just making sure that you're looking at the best way to take your profits out of the business, looking at things like timing of dividends, timing of salary payments, and also taking into account the new national insurance rate that's coming in from April this year. I can see we've had some questions come through. So like Joe mentioned, I will come back to the questions at the end of the webinar. So moving on to personal tax planning. So a few points that some people may not know. So there are some tax exemptions that you can get, such as the nil rate band for capital gains tax, and looking at transferring some income tax rates between spouses. And this is really important if your income is over 100,000, especially if your income is between 100 and 125,000. And that is because, if you don't know, you lose your personal allowance in this band. So at the moment, everyone gets just over 12,500 as a personal allowance for income tax that they don't pay any tax on. Now, if you earn 125,000, you lose all of that personal tax nil rate band that you don't pay any tax on. And what that means is your income between 100 to 125,000, because for every £2 you lose £1 of the allowance, it effectively is a tax rate of between 60 to 65%, which, as you can imagine, not many people like to pay that. So if possible, and if you should really be looking at what your income is at this time of year, because you've had 11 months pay slips or 11 months worth of income, and you can really get a feel of what your income is going to be for this tax year. And what we do recommend at quite a few clients is, if you think your income is, say, going to be, I don't know, 110,000 for this tax year, you are much more better off to pay that 10,000 into, for example, a pension, and keep your income to that 100,000. Now, if you were going to pay, say, 65% tax on that 10,000, and now you pay it into a pension, therefore you're not going to pay that tax, effectively, the government have contributed a large amount to that 10,000 payment that is going straight into your pension. So again, this is a perfect time of year to start looking at this. And if your income is going to be around those levels, please do speak to your advisor or speak to someone that can kind of help you and talk you through what is best to do. And again, like I mentioned before, looking at any other benefits that you might want to exchange that salary level for, to move into either a pension or something else. So I mentioned this just before about timings of dividends and bonuses, and making sure that effectively you have those conversations with your accountant to make sure that you're using up your band. So if possible, we always try and keep our clients to various bands. So you're 50,000 or just over 50,000 now, which is your basic rate band. So a dividend, you only pay the basic rate on. And then, like I mentioned just before, the 100,000 band, which if you go over that, is when your tax bill starts going up quite considerably. So if you're a business owner and your wife is a shareholder, look at the timings and the dividends between the two of you, because if your income might be 150,000 and you can pay 50,000 of that income to your wife, so she's paying that as a basic rate band or basic rate taxpayer, and your income then stays to 100,000, between the two of you, you'll save a considerable amount of tax. So again, another planning method is looking at any loans you make to the business. Each individual gets an interest-free, tax-free allowance. If you're a basic rate taxpayer, that's £1,000, but it drops down to £500 if you're a high rate taxpayer. But again, if you've loaned the business some money, you could charge interest on that loan, the company has an expense for the interest and therefore saves the corporation tax. And if you're up to your interest-free allowance, you don't pay any personal tax on that. And lastly, just on stamp duty, as everyone knows, stamp duty is very expensive, and moving house is a big cost to everyone. But if you are looking to purchase a second property, and that includes any properties that are bought in companies, then you have to pay the extra 3% surcharge on top of the current stamp duty rates. So now we are going on to talk about inheritance tax. Like I said, sorry, I'm going quite fast through this. There's quite a lot of areas to cover, but if you have any questions, please do put them in the Q&A section, and I will try and come back to you after I've got to the end of the webinar. So inheritance tax planning. Wise, yes, we're looking at end of tax year planning and planning for this tax year. Looking ahead for the long term and for the future, a growing number of people are going to be affected by inheritance tax. And why is this? Well, a lot of people who owned property for 20, 30 years, the value of those properties have gained considerably. You may have $500,000 property, you might have some stocks and shares, some cash, and you, by the time you add up the various parts of someone's estate, they could become to a reasonable amount. Now you get your nil rate band of 325,000, and with the primary resident allowance, that takes it up to $500,000 that you can potentially pay no inheritance tax on. Just one point: if you pass your nil rate band, your $500,000 passes to your spouse. So effectively, on the second death of a couple, there's £1 million that you would have no inheritance tax to pay on. But let's say your total estate is 1.5 million. On that $500,000, it's a large amount of inheritance tax to pay that the beneficiaries are going to have to find to pay. So just a few measures and things to think about. So if you leave a chunk of your estate to charity, and it has to be at least 10%, then that reduces the amount that you have to pay, or the rate that you have to pay of inheritance tax from 40% down to 36%, which could save the family money in terms of actually the tax rate they pay. And if you were going to donate a certain element to your to charity anyway, then it might be worth actually increasing. If you were going to put 5%, it might be worth increasing it to 10%, and then you get that tax saving also. Again, if you can give gifts up to £3,000 per tax year, and those gifts are therefore not counted as part of your estate, like it says on the slide, you can carry that over for 2 years if it's unused. But any larger gifts, so let's say you want to give your children £100,000, that is a potentially exempt transfer for IHT purposes. And what that means is, if you live for longer than 7 years, then that drops outside your estate. But if you pass after, say, 5 years, there is a taper allowance for that amount. So the full 100,000 won't be part of your estate, but an element of it will be until the 7 years, and then it drops out completely. So again, if you're kind of in your older years or your elder years, it might be worth looking at these kind of things to try and reduce your estate. And if you can pass some assets over now and you live for another 7 years, you then haven't got to worry about that. Just a few other inheritance tax planning points. If you're an individual who has quite a high income, you can look to make regular gifts out of your income. And we actually do this for quite a few of our clients, because it's a very good method of moving funds out of your income and passing it down to your children or grandchildren. But the revenue are quite tight on this. And what I mean by tight is you need to be able to prove that is just regular gifts out of your income, and therefore it's not reducing any capital from your estate. So let's say you're someone who earns £500,000 a year and you want to pass 50,000, 100,000 a year out of that income direct to your children or grandchildren. Now, as long as you can prove that that doesn't directly affect your way of living, then the revenue are happy with that. Again, passing on your pension. So I would always recommend my clients that the last thing in your estate that you should touch is your pension. So if you don't need to use your pension and you have other funds kind of in other assets, you should use those assets and use those funds before you start drawing down your pension. Now, I'll come on to pensions in a moment, and as you know, you can draw down 25% of your pension once you hit a certain age. But if you don't need those funds, from IHT point of view, it is better to not draw that down, because when you then pass, your pension passes on outside of IHT purposes. Now, depending how old you are when you pass, depends on if it's fully outside of tax and therefore the beneficiaries won't pay any tax, or if you're over a certain age, the beneficiaries will pay some income tax, but only on the amounts that they draw out of the pension at their income tax rates. But again, if you're not sure or you want some further information on this, please speak to us or speak to your advisors. And again, we do quite a lot of trust work for some of our clients, and these are ways of moving funds into a trust and therefore out of your estate as long as you live for the 7 years. And effectively, because it's in a trust, you can still manage those funds, and you can still make sure that the children, the grandchildren don't just spend all the money or draw all the funds out, but they are the beneficiaries, so it will still be outside of your estate after a certain amount of years. So moving on to pensions, again, pensions are a very tax efficient way of saving for your retirement and saving for your long-term future. So the current lifetime allowance is just over £1 million. And what that means is you can pay into that pension up to that just over £1 million, 1073, and effectively you won't pay any tax on putting those funds into the pension. If you then start putting additional funds over that allowance, you do then pay tax on putting additional money into the pension. In terms of how much you get, and how much you can put in each year, so each individual gets £40,000 a year to pay into a pension tax-free, and you can carry over your last 3 years unused allowance. So effectively, you could, if you wanted to, if you've not used your last 3 years allowances, you could pay 160,000 into a pension in 1 year. Now, there's a lot of things that you need to look at, and I would always recommend to speak to a financial advisor, because they would look into this in depth and make sure that you can put in these amounts. If you're a higher earner, that 40,000 that you can pay in each year gets tapered down. So again, speak to your accountant or your financial advisor, because there's potential that actually you can't put 40,000 in, you can only put 10,000 in that tax year. So you need to make sure that before you make the pension payment, you just make sure you know exactly what you can put in. So with pension payments, you need to have a certain level of income to be able to make those pensions. Now, every individual, no matter what income they have or what earnings they have, can pay in £2,880 into a pension, and the government then top that up with 20%. So effectively, it's 3,600 gross a year. So, and again, another way that you might want to start saving for your children is to start making pension payments for your children. So you can set up a children's pension and put in £2,880 a year. If you did that for, say, 5-10 years, and you let that build with kind of compound interest over 50 years, that potentially could build up to quite a considerable pot. So again, speak to your financial advisor, and they will be able to go through this with you. As I mentioned before, you can draw down 25% tax-free of your pension once you're over 55. but like I said, you might not want to. So speak to your advisor and have those conversations with them. So just looking at a few tax efficient investments. So have you thought of ISAs, share schemes, EIS, SEIS investments, venture capital trusts, life assurance bonds, offshore bonds? There's loads of different tax efficient investment options. Not going to go into depth on them now, but if you have any questions, please do let us know. So moving on from taxes and looking now at making tax digital and how the tax system is going to change over the next few years. So why the revenue do this, a move into digitalising the tax system? Well, they want quarterly reports now going forward that they can monitor what businesses are doing. Now, why do they want that? We know long term they're going to want tax to be paid quarterly, and it's a way of them to get tax revenue in quicker. They haven't yet said they're going to make the tax payments quarterly. Obviously, VAT gets done and reported quarterly, and you pay the VAT quarterly. Income tax, as you may or may not know, you pay payments on account, and they get income tax on account. But at the moment, for any other taxes, especially corporation tax, unless you're a large company, you don't pay corporation tax until 9 months after your year end has finished. So they're looking at a way to digitalise the system, and this is going to affect a lot of businesses and individuals, because if you're VAT registered, yes, you have had to register for making tax digital the last couple of years, and therefore most now VAT registered businesses are on softwares like Xero or QuickBooks or Sage, and they have got digital records. But for, say, landlords who have a property portfolio, not many of them probably have a digital system and keep digital records. And going forward over the next few years, they are going to have to move their records to be digital. So we're starting to having those conversations with our client, and I'm just going to touch on a few of those kind of conversations now. So, as I mentioned, for VAT registered businesses, if your turnover was over 85,000, you've had to register for the last few years for MTD. There was a soft landing period, but now all new businesses have to be registered for MTD and therefore file their VAT returns digitally. So for April 22, so from next month, any VAT registered business now needs to be registered for MTD. So even if you're voluntary registered and your turnover is, say, 50,000, but you're still VAT registered, you now have to file your VAT return through an MTD compliant software. We use Xero, and whilst we use all softwares, Xero is our preferred software. And if you need any help with setting up the software or any training, we can offer that to our clients and any other businesses. So what do you need to prepare to get ready for MTD? And the next slide that I'm going to show is the current timeline that HMRC have announced in terms of moving income tax and income tax and corporation tax over to the MTD system. As with anything with HMRC, these timelines might slide and they might get pushed back. It's been pushed back with everything that's happened over the last few years. So at the moment, these are the timelines that they're saying that they're aiming towards. But what the businesses need to do, so they need to make sure that they've got digital records and can create a VAT return or tax return or corporation tax return through a compliance software that can link to HMRC's digital system. So like how you file your quarterly VAT return at the moment, and that software is linked directly to HMRC, you're now going to have to file that same return for income tax and corporation tax. And what that will mean is you'll file your 3 quarters, so 3-quarter returns, and then your last return will effectively be your final return, which will have any adjustments that need to be made and will be your final return that will calculate your final tax for that year. So as I mentioned, these are the current timescales. So what they're currently trying to aim for is by April 24, so what's that, just over 2 years now, that for all income tax, so for anyone that files a tax return and has self-employed income or landlords with income above 10,000, that you will need to file a quarterly return now to HMRC through an MTD registered compliant. So you might think, okay, I've got a property portfolio, I've got 2 years, I don't need to worry about this now. Yes, you do have 2 years, but really you need to start getting the steps in place to move your systems and move your records over to an MTD registered software, because that time will quickly pass, and before we know it, there'll be a few months left and you will need to make sure you get this in place. And then at the moment, they've said the earliest date for businesses and corporation tax will be 2026. So again, if you're a VAT registered business, this shouldn't be too much of a change, because you most likely currently have digital records, you currently file a VAT return, so this will just be an extra return that will need to be filed each quarter. If you're not currently VAT registered, or you're a small business and you don't currently keep digital records, you will need to, over the next few years, get this in place. So please do speak to us. We are starting to put a lot of time and resources into making sure that our clients are ahead of the curve, and make sure we get this in place before the timeline comes before us. So thank you all for your time today. I'm just going to look at the question and answers that have come, the questions that have come through. If you do have any more questions, please do send them on the Q&A tab now, and I will answer as many as I can. So the first question, if you buy an electric car through a company on PCP, can you claim the electricity supply to the car through the company, or does it have to be paid personally? So PCP is a personal, is normally a personal finance of buying a car. Therefore, if you want to buy an electric car through the business, there's normally two or three ways of doing it. One, which most clients do, is they'll get a business contract hire. So you pay a deposit, you pay monthly rentals, and then at the end of the 2, 3, 4 year period, you give the car back. And the company gets full tax relief on the rentals, and the company, if you're VAT registered, can also claim 50% of the VAT back on the rentals. Now, if you do want to buy the car, you can either buy the car cash, and let's say it's a £50,000 car, you can buy that cash. The company will then get full capital gains, will get full relief on corporation tax for that car. So we'll get full capital allowances of 100% as it's an electric car. But again, you might not want to lay out that cash. So you could do something called a hire purchase. But for a hire purchase, it's slightly different to a PCP, because yes, a PCP, you can give the car back at the end, but most PCP finances are set up for personal and not for business. So look, you can speak to your dealer, your garage, and as long as they'll give you financing and it's a business finance in the company name, then that's no issues to put through the company and claim the tax back. In terms of the electricity supply, if you've got a point that is at the office, then you can claim that electricity through the company. That's no problem. It's in terms of claiming the electricity through, if it's at home, because most electricity points at home go through your normal electricity bill, it's very hard to determine what element is relating to the vehicle and what element is relating to your personal electricity bill. If there is a way of you clearly distinguishing between the two, then you could potentially claim for some of that as a business expense, and obviously offset with the corporation tax. But again, it's potential for HMRC to challenge, one, what are you claiming, and is there any personal kind of electricity on that you're claiming back? So that's that. The next question, is the threshold before personal allowance or after? Now, I think they might be talking, they haven't put their name on there, but I think you might be referring to the dividend allowance. It's £2,000 dividend allowance, and that is on top of your personal allowance. So you get your just over 12,500 personal allowance, and then you get your £2,000. So you get 12.5 plus you get your £2,000 dividend allowance. So effectively, with the two, you get the 14,500 tax-free allowance. Sorry, they've just sent another question. No, it was the 100,000 threshold that they were referring to. So that includes the personal allowance. So it's not 100,000 plus your 12,500. It's 100,000 including your 12,500 personal allowance. So looking at your bands, if you're employed and you don't get a £2,000 dividend allowance, you've got 12,500, which is tax-free. You pay for PAYE, you pay some national insurance because the national insurance threshold is slightly less than that. From 12,500 to just over 50,000, you pay 20%, which is the basic rate for employment income. And then from 50,000 to 100,000, you pay the higher rate, which is 40%. The high rate is actually all the way up to 150,000, which it then jumps up to 45%. But as I said, between that 100 to 125,000, the rate is effectively a lot higher. So any more questions before we wrap up? No, I think that is everything. Okay, brilliant. So just wanted to, thank you all for joining today. If you do have any questions, please do get in contact with us. We're always happy to help, and obviously we're here to try and minimise your tax bill. So please do, get in contact, and thank you very much for joining.